Hello, welcome to our virtual presentation. Thank you so much for joining us today. The Murray Wealth Group portfolio management team, Bruce, Jamie, and Mike, are with us today to provide their insight on the market and our portfolios over the last few months and what we are looking forward to. The format of this talk will be in two sections. The first will be an exclusive company presentation by our team addressing current market conditions and answering some of your questions you submitted in advance. After which will be a Q&A led by our advisory board chair, Susan Dalhoff, to give you, our audience, an opportunity to ask further questions of our portfolio management team. Please feel free to ask anything about the information you heard today, our current holdings, or any questions you might have about the firm or our investment process. I'd like to take a moment to introduce our team. Bruce Murray, our CEO and CIO. Bruce has over 45 years in the institutional money management business, and he's spent 25 years in McLean Budden as an executive vice president and managing director. Michael Hakes, our senior portfolio manager, has over 25 years in the global equity portfolio management and analyst experience. Prior to Murray Wealth Group, he was with the British Columbia Investment Management Corp, McLean Budden, and Altamira Management. Jamie, with over 15 years of experience with a broad background in financial and strategic analysis, including Desjardins, Investors Group Corporate, and Dundee Wealth. Between them, we have over 75 years, of experience in the money management business. So without further ado, I'd like to introduce our CEO and CIO, Bruce Murray, and he'll take you through our market outlook.
Thank you and welcome everybody to our presentation. So I'm going to do about 14 slides on the current economy, the outlook, and what we think is happening for equities. And our thesis is we've seen the bottom. Now is the time to invest. And we believe the recession is discounted. Inflation is declining, and we'll show you some charts on that. The Fed rate increases, well, maybe not done, they're largely behind us. And the global bond markets have stabilized, interest rates have stabilized, and they are fully anticipating any future Fed increases. As to equities, we think stock valuations are attractive, earnings are still up, and technology is still the place to be for long-term investors. Next slide, please, Jamie. So the recession is discounted. This is a slide of US GDP. And you can see in the first 2 quarters of this year, we actually had negative GDP. We're down 1.6% in the first quarter, down 0.09 in the second. And 2 down quarters is traditionally what makes a recession. But among the other things required to make a recession are rising unemployment. And that is one thing we did not have in this recession. This recession was not demand-driven, it was supply-driven in that manufacturers and other providers of goods to the market could not meet demand, and therefore, because of COVID and the shutdowns both in China and North America and Europe, and then the war in Ukraine throwing on top of it, is what caused these down quarters. As we'll show later in the presentation, we believe that these are largely behind us, and we will start to see a return to stronger GDP growth in the second and third quarters and into next year. As to a recession, there may, and I underline may, be a recession once supply catches up to demand, and we fill the unmet needs for automobiles, for washing machines. I don't think we're going to fill the unmet need for housing for some time. But those are the things that may cause a recession, but it will be at least, it'll be well into 2023 before that happens. Next slide, please, Jamie. Inflation is declining. This is maybe a bit of a bold call by us, but we think inflation numbers peaked in June, and they're forecast by Bloomberg to be 8.8% in July, and they actually came in at 8.5%. So the decline is beginning. We've seen oil prices continue to come down. Food prices will remain high till the world readjusts to that, but they probably have stopped going up, as have a lot of other things, and we'll talk more about that later. Next slide. And one of the things that has happened in this cycle is the Federal Reserve Board's action to increase interest rates has been very, very aggressive. And you can see the red here for 2022 by historical other cycles. And, this has been as a reaction to the pop in inflation that really occurred when, there was maybe some underlying inflationary pressures that we're building. And then the war in Ukraine created just this pop along with COVID shutdowns for some other things. And so that is why they've been so aggressive. And we'll talk about it a little bit more in the next slide. And so this slide is a little bit complex, but the dark blue boxes here are the Federal Reserve Board increases that have actually happened. This is from Goldman Sachs. And this is maybe a week and a half ago. And these are the forecast changes in the dark boxes that are sort of shaded, and the light boxes are where the market is saying that the future Fed increases will come in. Anyway, we can see that in total there's maybe another 100 beeps of upward pressure, and we think some of the statements that have come out of the Fed, they will consider the massive decline in the economy and in inflation that we have seen in the second quarter, and so they may actually back off on some of these. The bond market on the next slide has actually peaked. It peaked, as you can see, in June at 3.5%. It's now back below 3%, and therefore we think the bond market is got all kinds of economics PhDs in these teams at the big investment houses, and so they are forecasting that we've seen the peak in interest rates on the long bond issue, and if bonds do hold in the sub 3% range, stocks can flourish. Jamie? Now we turn to stock valuations, and this is the collapse in the PE multiple that occurred in the first half of the year, which brings us right back in line with where we were, right from 2012-13, where the lower inflation driven by the decline in the economy in 2008-9 and the tightening of the banking system, but as well, productivity has been very high across this period, and automation has led to a lot of low inflationary GDP growth. And so we think PE multiples are at good buying levels at the current time. Jamie? Surprisingly, maybe for what we've had, earnings are up. They're going to be up almost 10% this year. Now remember, earnings are not based on real GDP, they're based on nominal numbers. And so companies have been pushing price increases through along with inflation. And so that's why we're seeing earnings growth this year. Next year, we hope to see a better component of real earnings growth and less inflationary impact. But you can see these numbers are still up, and the market will price in the inflationary gains because our prices we pay for stocks are nominal as well. Next slide, Jamie. Thank you. And one of the things that probably everybody's heard about is the great shortage of microchips. This slide is by Gartner Group, which is a leading consultant in the technology world. They consult both to companies and to investors and everybody, and they're showing that the severe shortage of chips in last year gradually diminished across the last 3 quarters, and we actually started producing enough chips in the second quarter, and we've seen some of that. This takes time for the inventory to flow into the manufacturing facilities, etc. And we now think that this current quarter we're going to see chips to allow the auto plants and stuff to start up. And if you read this commentary from the auto companies and the auto parts suppliers, as we wrote up in our Linamar report that we sent to those on our mailing list, auto production is going to really pick up in the second half of this year, which is one of the reasons that we'll see stronger GDP growth in the second half of this year. And along with that, I can assume washing machine production and a lot of other things that have been restrained will also pick up. But by year end, we think the chip shortage will be virtually fully discounted, so that 2023, 2024 will be more normal years for industrial production. And we're actually seeing there's some of the chip producing technology companies have actually announced that their earnings are prices are starting to come down, and they're not expecting to do as well as they did the last 2-3 quarters. Amy? And the other story that is in the headlines with what Russia's done is energy, and energy will be stronger for longer. And we've got 2 charts on here just showing that. Cushing, Oklahoma is the big hub where all the pipelines that feed down into the refineries in Texas and Louisiana. And there's a big storage area for crude. And as you can see on this chart above here, these are in millions of barrels. So there's normally, 45 to 50 million barrels of oil in storage at Cushing as it's being moved and switched from pipeline to pipeline. And you can see right now we're about half that number, and that number is not increasing at the moment. The other factor, influencing crude is the the petroleum reserve that the U.S. has, and you can see at the end here they have released, well over 100 million barrels of oil into the market since the invasion, and that number is still going straight down. And so, at some point in time, that 1 million barrels a day, they've got a while to go, but this reserve is going to the pressure it's taking off the markets will also pass, and so longer term we think oil is going to be higher than it historically has until the Russian situation evolves into either the world replaces production, which will take several years, or something else happens that allows it to happen, that allows the stocks to normalize. And so we'll move on to that. And another interesting thing here is this is a chart of natural gas exports to Europe from Russia. And you can see that they actually started to decline during the pandemic, just probably because Europe didn't need as much energy as a lot of stuff was shut down. And they have really fallen off now. And there are 2 reasons for that. Number one, I think Putin is using it as a threat, but at the same time, we continue to read that, as Western technology was pulled out of Russia, their ability to maintain production is declining rapidly. And I mean, the little transformer issue compressor station issue that Canada was involved in is just an indication of that. They may get the compressors back, but they're not getting new facilities from Western suppliers or technology. So the natural gas shortage, will also be here for a while. Thank you, Jamie. The last thing we want to talk about is technology, and technology is still a place to be. We've got 3 or 4 slides here. This is technology as a percent of R&D spending in nominal GDP. And so you can see, it's risen from 1960 at 15% of capital spending, and it's now over 50%. And this has been an increasing number for the 70 years that are on this slide. Next slide confirms the same thing. This is revenue growth of the S&P 500 is the dark line, and technology is the blue line. Again, you can see the massive increase in technology as technology permeates our day-to-day life much, much more. So again, great underlying driving force for technology. Jamie? So we just summarize our outlook. Central banks have tightened the economy extremely quickly. Bond markets are now pricing in a return to lower inflation. We believe the outlook is improving. Dislocations peaked with the Ukrainian invasion, and inflation was largely driven by the shortage of physical goods, autos, appliances, etc., and is falling. The economy will continue to reopen in the second half of 2022 and into 2023. And as we just talked about, energy development has lagged in the West due to carbon issues and was filled by Russia. And it's going to take higher prices for an extended period to rebalance this. And our summary stock valuations are attractive at current levels. I'm going to turn the presentation over to Mike, who's going to talk about our global equity fund, where it stands.
Hey, thanks very much, Bruce, and welcome everyone to the call. And thank you very much for joining us in the middle of August. The next several slides go over the Global Growth Fund, its characteristics, performance, and then I'll talk about some recent changes we made in the fund. The key points on this first slide is that the Global Growth Fund is concentrated. We can hold anywhere between 30 to 45 names. We currently have 35 names in the portfolio. Also, the geographical mix is important. We have 75% of the portfolio in global stocks and 25% in Canadian. And we have a range of that mix. The global part can go up to 80 or down to 70, and the Canadian part can also go anywhere between 20 and 30%, just to give us some flexibility if we see names or opportunities within either of those territories. We also take a sort of a tiered approach to the portfolio composition and the weights of each holding. The weight is driven by several factors, including size, quality, and what I mean by that is the mode of a company, the competitive positioning, the pricing power, the management track record. And also one factor that goes into the size of the weight of the holding is also our price return targets. We have return targets on all our portfolio holdings. In terms of that tiered approach, the high quality names, a good example of this would be Google or Alphabet. And it's currently our largest position at 6.5%. A well-established mid-cap name would be, a good example would be Intuitive Surgical, which is the leader in the emerging robotic surgery industry, and that's held at 2%. A high return potential stock would be a Canadian name, actually, Docebo, which is Latin for I will teach. And again, a small Canadian company offering learning management and training platforms to companies like Amazon Web Services, BMW, and L'Oreal. And that's at 1.5% of the portfolio. So we recognize names such as Docebo. We don't want to put that at 5-6% because it is super high risk. It's a small company. It's emerging into profitability. So that's kind of a risk management tool that we use to make sure that we don't go off the rails. With respect to the bottom part of the slide, which refers to portfolio disciplines, I think an example would be a good idea to highlight what we do here. And one of our names to highlight this example is United Health. For those who are not familiar with United Health, it's one of the largest healthcare providers in the US, offering healthcare benefits. I mean, that's insurance to individuals as well as small and large businesses. Their other division is called Optum Health, and this spans, pharmacy services, surgical care facilities, healthcare innovation, and healthcare information service. And this is a name actually we've known for years and years, like 20 years plus, quite frankly. It predates Murray Wealth Group, and it goes way back to our experience at other firms. With respect to the Murray Wealth Group experience, you can see on the slide here, November 2018, the stock was $281. And prior to that, we had price targets on this stock, but they never really got over 5 to 10% returns in terms of our price targets. So it never really met that hurdle of showing high returns to get into the portfolio, even though it did meet all our other criteria. The management track record was excellent. It showed consistent revenue growth, good margin expansion. It was clearly a market leader, and EPS had grown consistently in the low teens for a very, very long term. But again, it offered a very low price return. So for those who you remember back in late 2018, early 2019, it was the Democratic primaries, and Bernie Sanders was on the bill, along with Joe Biden vying for that Democratic leadership position. And there was a lot of rhetoric going around in the media and in the US on the healthcare system and how Bernie was going to change the entire system, Medicare for all. And that, of course, put a lot of pressure on the healthcare names. And you can see, it's kind of hard to see on the slide, but it went from 280 down to 220 in the spring of 2019 because of all that rhetoric and media attention that the healthcare industry got. That's a big downturn. in terms of stock price, but we didn't change our price target. We felt, that any real change to the healthcare system in the US was highly unlikely, and our price target remained unchanged. So that we took the opportunity to buy United Health around the $220 level. You can see here we bought it once in April, then again a few months later, and we took a 3% weighting in the stock. And then I guess Bernie fell off the radar, and the stock had a huge rally as people realized he wasn't going to make it onto the ballot, and the stock rallied to almost $300. Well, you can imagine at that time, United Health within the portfolio itself outperformed all the other stocks. So it was no longer a 3% weight, it was 3.5%. So at that time, and this is the same for all the names in the portfolio, anything that goes over 50 basis points over a target weight has to be addressed by the portfolio management team. And at that time, we felt that the stock had gotten ahead of itself and our return target had almost been reached. So we sold it down to the 3% weight. And we put it into the proceeds into other names that we felt had better upside. I think that's a good example of what we do on a weekly and daily basis in terms of portfolio management. And most recently, you can see the stock has rallied nicely over the last 2 or 3 years, and it's now actually at $540. And we've sold it a few times, most recently, in the last 6 months, because it's done so well. The price target is while it's higher than where it is today, it's very, very close to our price target. And as you know, we've seen a lot of market volatility. So we've taken the opportunity to trim it down. It's now down to 1.5%. And we took the opportunity to buy some of the names that we felt have become very attractive in terms of valuation. So a nice 4-year return and a good flavor of how we trade within the portfolio, adding to names that we feel have better returns. The next slide is all about performance. You can see here that we've got, now the next few slides, you got to be careful because you have to look at the end date. So in this case, this slide is as of July 31st, 2022. So it's 1 month after the quarter end. So you can see here the 1 month number is 8.6% positive. So that was a great rebound off the bottom of June 30th. And you can see the longer term numbers and inception numbers are still above our benchmark. When our benchmark, as a reminder to people, is made up of 75% the MSCI World and 25% the TSX. The bottom part of the slide is what we call, and the industry calls, upside downside capture. And this is a number that measures you relative to your benchmark in terms of what happens to the fund price on up days and on down days. And in this case, it's measured over 4 years. You can see the upside capture is 139.4, which means that if the market went up by 100, then the portfolio would go up at 139.4, so more than the market. And by the same token, on the downside, and this is typical of a growth fund, it would go down more than the market. But in this case, it does go down more than the market, but not as much. It doesn't go down as much as it goes up, so it's asymmetrical. So as long as you have more up days and down days, theoretically, you should do better than the market. So that's why you can see over the longer term, our inception 5-year, 3-year, and the minute you'll see 2-year numbers are actually quite positive in terms of performance against the benchmark. We also wanted to show how we were doing against our competitors. So the next slide, as I mentioned, this is the end date is June 30th and not July. So this is pretty much the nadir in terms of pessimism in the market and what Bruce alluded to in his earlier remarks. You can see as of June 30th, the Global Growth Fund was down 25%. But since then, as of August 10th, it was only down -15. So a great rally, almost 10% over a short period of time. And it's continued that way. If you did it as of yesterday, we were down 13.5. So the market is stabilizing. We're seeing some good returns. The other thing I would highlight here is a quartile ranking. So the industry likes to look at everyone, put them in quartile rankings. If you had 100 competitors, we're showing 4 here. If you were in the first quartile, then your performance would be the best, top 25. The next second quartile will be anywhere between 25 and 50. Third quartile, 50 to 75. You get my point. So we have slipped into the fourth quartile for year to date in 1 year. However, we can see longer term, 2, 3, 5, and 7 years, we're still solidly in the first quartile. And if we continue to see this market rally, we should hopefully stabilize the shorter term numbers for our investors. And I would highlight that when you're looking at any fund in terms of comparisons, it's always better to look over the longer term to see how that portfolio and that approach and style has done through the cycles. And we've probably seen at least one cycle over the last 7 years, and you can see how we have done and our competitors have done through that time period. Okay, the next slide is just a portfolio snapshot, again, as of June 30th. And you can see, as I talked about earlier, the smaller weights reflect their higher growth nature, and they're all under 2%. You can see Twilio, Converge, Docebo, which I mentioned earlier, Zalando, all the speculative sort of nature. And those all add up to roughly 10% below. So below that threshold I talked about earlier of our high alpha stocks, anywhere between 0 to 15% of the portfolio. You will notice two names there, Eli Lilly and Morgan Stanley. Those are huge cap, well-established global names with low weights. So, it really depends on, where we are in the portfolio management. So, for example, Lilly is a new name to the portfolio. We just added it a little while ago. And as you all know, the US has a big problem, and that is obesity. And Lilly has a new drug coming out, and that could be a major success in the North American and global market for obesity. So we've taken a small nibble there. Just like United Health, actually, Lilly doesn't have a huge return right now, but as the rollout of this drug plays out, we hope to add to the weight of Lilly, and I'm sure that everything goes well, that name will add to it a few market volatility as we see new entry points. And the same thing with Morgan Stanley. This one historically has been a top 10 weight for us and has been a major contributor to our performance over the last 3 to 5 years. But as it approached our target, we have rotated into some other names who provide a better upside. In terms of changes to the portfolio, every quarter we provide information with regards to changes in the portfolio, and this slide illustrates this. We give our investors visibility into new additions, positions we've sold, what's helped or hurt in the portfolio, and that's contributors or detractors, along with some weighting changes. And you can see over the last quarter, we've added BP and Starbucks, and we've sold Chevron, Enbridge, Dollar Tree, and Alliance Data, which is most recently name changed to Bread Financial. And some of those trades are related. Dollar Tree had met our price target, and Starbucks, which I'll talk about in a minute, showed very, very attractive returns. And with the same token, Chevron, we also sold it into BP. And again, BP had higher returns. In terms of the weighting changes, you can see we took up Linamar, as we talked about earlier. We're expecting some solid production in the auto industry, which Linamar will benefit from. They just reported a great quarter, which surprised the market, but we were well positioned there. Took down Broadcom a little bit because I think as it got overweight, we took it down to weight. I'm going to talk about two stocks now. The first one is Starbucks, one of our newest entries, but we have owned it before, and is one of those stocks that hit our price targets and we saw the better opportunities. But we just saw a great opportunity back in May to reinvest in the stock. It was being hit hard by really a trifecta of bad news. China, the country, had basically shut down again for COVID. Starbucks management had pulled guidance entirely on China, and China is a huge part of the Starbucks growth story. So that weighed heavily on the name. Supply chain costs were much higher for them and Starbucks, and for everyone really, as inflation grew. And supply chains were in disarray. And the CEO of Starbucks announced his retirement, probably a bit earlier than the market was expecting. And Howard Schultz, the original CEO of Starbucks, had to come in for the third time to take over the helm of Starbucks. So So great entry point. I mean, it traded at the point of entry at $70. It was trading at about 24 times current year earnings. And if we look at it historically, it historically over the last 20 years has traded at 30 times earnings. So we felt it was overdone. And when you look at the opportunities for Starbucks in China, for example, and if you look at the US market, they have about one store for every 20,000 people. China, they have one store for every 250,000 people. Mind you, they'll probably never get to the penetration levels in US, but that is a long runway of growth for China. And we felt that the pessimism for the stock was well baked in. So we added to Starbucks. Netflix is, I think, another good example of a contributor that went quickly to a detractor in the portfolio. This is a name we bought in late 2017. It had only 39 million subs or so, and the initial weight was 1.5%. So again, going back to that more niche, high alpha return stock kind of mentality we have, we did not put this in at a huge weight, but at the time it had massive subscriber growth runway in North America, Europe, developing markets, huge runways of subscriber growth, which they actually executed on, as you can see by the stock price movement, very well for the next 4 or 5 years. And we did sell it over a few times over that period, as you can see, as it moved up, probably up above 1.5, probably closer to 2, or even slightly above 2 at some periods over that time. Well, we trimmed it down back to the 1.5%. Unfortunately, the whole market, COVID obviously accelerated that subscriber growth, but I think the market was still focusing on that $300 million target. And unfortunately, you can see at the end of 2021, while everyone was expecting 300 million subscriber growth, unfortunately, it came to an abrupt halt, as they probably brought forward a lot of subscribers through COVID. So that really led us to really assess. We sold it a few times, obviously over a 5-year period, but the abrupt halt happened so fast that we led us to review our thesis on the stock, which is crucial for every name we have in the portfolio, is that thesis. So basically, subscriber expectations have stopped at that 220 level, which now actually Disney reported a few weeks ago, they're also at the same level, 220 million. But I would say that Netflix specifically has always been never add the advertising opportunity for Netflix. Management has always said we'll never offer ads. However, the subscriber growth stoppage they've readdressed the opportunity for subscriber growth, and also that 220 million subs that they have, there's another 100 million people who are freeloading off, sharing login information. So there's two levers that we're going to see over the next 6 to 12 months that the Netflix will try and use to take that top line higher. And ads can be very lucrative. And the same thing, if they can monetize those 100 million freeloaders, also could be very positive for Netflix now at the new valuation level. It only trades, well, at the very, very bottom, it traded about 19 times earnings. Now it's trading about 21, 22. It's had a huge rebound off the bottom, actually, even though you can't really tell from that a slide because it's over a longer period of time. So we are addressing this one now because of the new thesis, but there could be a lot of upside with the two new initiatives. I think that's it for me, and I'll give it to Bruce for another example of one of our holdings. You're on mute, Bruce.
Thanks, Mike. So MasterCard is the type of company we love to find, and you can buy and hold. There's a very long-term move from a cash and check economy to a digital economy where everything is just done electronically. And so you all know MasterCard and Visa, they're very similar. So it's the world leader in payment processing and identity approval. And as travel picks up, everybody uses a credit card when they travel. So this is an immediate opportunity for higher for MasterCard to make more sales and more profitability as travel recovers. And underlying that is that digital transactions are gaining share worldwide. And Canada is one of the leaders in it right now, but we're well ahead of even the US. And MasterCard is focused on increasing software and analytics fraud and authentication, which we can all understand is a huge issue. And that's why you get the phone call when you make a transaction that is not what you normally do, or you turn up in a different city that is an alert anyway on their fraud systems. And a continuous margin improvement is expected. And anyway, 2021 they had revenue of about $19 billion, which was 12% higher than 2019. 2020, because of the shutdown of the economy, did drop. We expect 2025 revenue to be 50% higher at 33 billion, and it's higher than 2022. And our 2023 target price is $420. It's about $353.60 today. It's 20% upside, and if we can get 20% out of the stock every year, we'd be very, very happy. And I'll leave it at that and turn it over to, is it Jamie, your turn?
Yeah, thanks, Bruce and Mike. I'm going to switch over to our other fund, the Income Growth Fund. And so just a little bit of compare and contrast versus the Global Equity Growth Fund. In some ways, it's a little bit of the inverse of that, so it's a completely separate product. But the key message is that the way that we evaluate a company, the way we look at a stock, a position, and whether we purchase it, is really the same fundamental analysis. It's just a little bit different criteria that we're looking for a company in the income fund. We're always evaluating the management team, keeping an eye on the balance sheet, ensuring that companies have sufficient cash flow to service their debt, and in this case, pay very high dividends. And so we look for, as the portfolio applies, companies that are growing dividends, and we like companies that have higher dividend yields. Now, oftentimes, a high dividend yield is associated with a higher risk, and that's true. But we think that there's opportunities to find good risk-adjusted returns in some of these portfolios. And the other difference between this one and the global growth is this is a product is 80% Canadian equities. Again, with most of our investors being Canadian resident, we get dividend tax credits on dividends that get paid out. So it's much more advantageous to purchase a Canadian dividend paying company versus an international one. But we do have a small international component to collect some diversification and to invest in some of the other great dividend companies around the world. It's a little bit smaller portfolio in terms of the number of holdings. Right now, there's 30 holdings. The global growth, I think, has 35 or 36 in it right now. But the same structure in terms of how we build it. We'll buy some larger cap, lower down the risk curve companies as our larger holdings, but looking for opportunities where we can outperform with some smaller ones as well, with 1% to 2% positions, more closer to 2% for the smaller companies in this one. And a similar discipline, when the target weight moves within 50 basis points of where it should be, triggers a review. We look at the target price, the dividend yield, and evaluate from there. And the last point, every equity has to have a 3.5% dividend yield to even be considered for purchase. And once the dividend yield, if the company's stock price appreciates faster than the dividend growth, once it hits that 3% yield mark, then it triggers a sell discussion. We don't sell it the day of, but we'll definitely look for a replacement with a higher dividend yield to bring in. And so if I flip to the next slide, you can see here the fund yield is 5.8% as of July 31st. So definitely we think this is one of the highest dividend portfolios you'll find in the market. And again, good long-term performance. We aim to get that 8 to 10% total return out of this, so about 5 to 6% dividend yields, and then a little bit of capital appreciation on top of that. And that's what we've mostly achieved, again, going back 7 years since inception, and fairly stable over the last 3 and 5 years. And this portfolio has actually done very well in the 2022 market we've had. It's up 2.8% as of July 31st versus the benchmark. You can see there down 7%. The benchmark again is weighted towards Canada as with the rest of the portfolio. So a little bit different benchmark returns versus the global equity growth. And that upside downside capture that Mike introduced earlier, you can see it's a little bit lower volatility. I think this portfolio too did see some additional volatility in the COVID 2020 shutdowns, when companies that are traditionally lower risk, like a REIT, a real estate firm, saw significant volatility with the stay-at-home orders. So, hopefully we can't predict the future, but hopefully the volatility will be a little bit lower as well going forward. But you still see that asymmetric upside downside capture in this portfolio. Here's a quick look at the fund holdings, but I think jumping off the page, you'll see a lot heavier resource exposure, more pipelines, more utilities, heavier financial services components on top of the energy trade that we have on right now. We have companies like Power Corp, Bank of Nova Scotia, TD, Manulife at bigger weights. And then again, that real estate component as well. Some names in there is European Residential, which owns multifamily apartments in the Netherlands. Northwest Healthcare Properties REIT, which is a company that owns medical office buildings in Canada, the US, England, Brazil, with all inflation-linked leases as well. So in a country like Brazil, where they deal with high inflation on the regular basis, Northwest has complete coverage for that inflation. And then some other interesting opportunities as well in Canada, in the US, Blackstone, being one of the world's largest private equity funds and a huge owner of US residential real estate, which even though the market's going through a bit of a correction right now, we still see US real estate as an attractive long-term play. And just in the interest of time, I'll run through the last couple slides pretty quickly. But here you can see the changes that we made as well. So Northwest, which I just alluded to as a new purchase in the last quarter. As well, we bought Danone, which is a company I think we're all familiar with, the French-based yogurt and consumer foods company. Now, even though it is headquartered in France, its largest markets are the US and China, so two of the largest markets in the world. And Danone's an interesting example where we actually met with the new management team. It hadn't been a great performer in the past, but there's a brand new CEO, totally new senior management team, new board of directors that's completely, taking a fresh look at the company. They've executed really well at some predecessor companies, and we think that there's a lot of opportunity for them to, no pun intended, trim the fat at Danone and make it on similar financial metrics as some of their peers, which would see a re-rating of not only the share price and the higher multiple, but probably higher dividend growth going forward as well. And just to highlight a couple of names in here, I won't spend too much time on these because they're both pretty simple stories. One is Chemtrade Logistics Income Fund. It yields 7.4%. This is one of our largest holdings in the fund. And this is a story we know really well. We've owned it for 4 years. It's a company that had some issues with a legacy lawsuit from an acquisition. They had really high legal costs. The old CEO, admitted that it probably wasn't the best acquisition. And even though the previous CEO was around for a long time, he resigned, and we've got a new CEO running the company now. He's really done a good job turning the company around right at the time we're into a cyclical upswing. So all their commodity prices are in really tight markets right now. The prices are moving higher. This you can see here on this chart is the caustic soda price. You can see it's pretty much near its all-time highs going back to 2010, 2011. Forecast to stay strong. And I mean, the really exciting part about Chemtrade is we're coming out of this 3-4 year period where they've really just been over levered, allocating all their money towards debt repayment and to their dividend. Now we're seeing prices start to recover. The debt levels coming down. They actually issued some equity to bring that debt down even further. And now for the first time in 5 years, they're investing in new projects. So this is pure organic growth. And the two projects, which you can see highlighted down in the bottom right corner, They're spending about 300 million over the next 2 years to expand their one's a brand new facility in Arizona. Another's an expansion of an existing facility, but this is to build ultra pure sulfuric acid facilities. And this is to be used for semiconductor manufacturing. So we've heard about this big onshoring of semiconductor fabrication, with the US wants to become, the leader in microchip design and manufacturing. Right now, a lot of it's done in Taiwan and China, which obviously has some geopolitical issues. So the US is trying to bring that back home. And this is a key component that goes into that process, and Chemtrade's a leader in that. So that should bring on another 65 million of EBITDA when those projects are done in the next 2 years. So the 20% uplift to their cash flow. And we think the company will probably look to raise their dividend even more at that time from an already very nice yield. And then the last one, which I'll highlight, Pembina Pipeline Corporation. I'm sure many of you are familiar with this company. It yields 5.5%. It's one of the largest midstream companies in Western Canada. And we just see, as Bruce was talking about in the outlook, we see a shortage of oil and gas over the medium term. We think countries like Europe and Japan are going to look increasingly to North America to meet their energy needs, rather than some of the foreign bad actors out there. And that's all great for Pembina. Pembina owns natural gas processing facilities. Actually just completed, I think, this week, a big joint venture with a subsidiary of KKR, the private equity firm, to form Pembina Gas Infrastructure. And on the back of that, they're raising the dividend. But they're also looking at an LNG facility on the West Coast. And they're expanding their natural gas gathering assets as well in Alberta, which, as we know, the Montney play is probably one of the great gas fields in the world. And it's going to see further growth over the next decade. So the more volume that comes out of Western Canada, the more Pembina's facilities get used, which means that they can earn a higher return on their existing assets. And so that's the Pembina story in a nutshell. Now I think we'll turn it back over to Sue Delhoff, who's going to answer or take some of your questions and allocate them out to the team.
Thank you, Jamie, and thank you to everyone who has sent us your questions. We'll try to get through as many as possible in the next 15 to 20 minutes. And for those of you that have a hard stop at 1 p.m., please feel free to leave us then. We understand, and we thank you for participating in today's call. If you would like further information about the Murray Wealth Group funds, please do not hesitate to get in touch with Michaela Dickey. For those of you that sent your questions to us ahead of time, there were a number of questions about the outlook for the market. And as Michaela noted earlier, we hope that the PMs answered them during this presentation. So turning now to some of the questions. Our first question asks for your view on Zalando's ability to return back to where it was prior to the slump. Jamie, perhaps you could take that one?
Yeah, sure. So Zalando is a company that we hold in the Global Equity Growth Fund. One of those we hoped was going to be a high alpha return stock. It hasn't worked out over the last year. So the quick 30 seconds on what they do is Zalando's a European-based e-commerce, a company that focuses on apparel. And 5-6 years ago, they were doing wholesale. So they would actually take inventory from a company like Nike or Coach. They'd purchase that, they'd sell it on Zalando.com, their website. Mostly in the Germany, Switzerland region. And now they've transitioned as they grew that. Now they have operations all over Europe. They're still expanding to some European countries. But they're moving from more of a wholesale model to a partner program, commission type model. So instead of purchasing Nike shoes and then reselling them, Nike's still going to control that inventory. Zalando can list shoes even from a Nike store. It's all connected. So somebody can purchase a pair of Nikes on Zalando that are actually in a Nike store somewhere in Europe. Zalando's fulfillment network can then get those shoes and get them delivered to the customer. And so as they embark on this journey, they're going to see their margins expand. Right now, as they've been investing to grow, they've grown historically 20% a year. Now they're going to be seeing the margins move up from a 3 to 4% net margin to hopefully an 8 to 9% margin, while maintaining that high 15 to 20% growth rate. So that was the story why we bought it. We thought the earnings were going to triple or quadruple over the next decade. And now we still see that happening, but unfortunately, the short-term effects of the Russian invasion, and we talked a little about the pull forward of e-commerce and sort of the Netflix story. Zalando's seeing a similar thing where some of the reversion back to the mean of in-person shopping has put a damper on the results, as well. European consumer commerce is really in the toilet right now with energy prices and gas prices where they are. So it's going to be a tough year in 2022, and the stocks reflected that. But the company did report 2 weeks ago. After a really rough first half of the year, they're going to be moving back into growth mode for the second half of the year. So they're going to grow their revenue 6% year over year in the second half, and then probably getting back to that 10 to 15% year over year growth in 2023 and 2024. So the story is starting to shape up. We think it's bottomed and it's going to do better from here. We've topped it up around its current price, back to its target weight. And yeah, we think the long-term thesis is still intact, but we're going to have to see how the European consumer shapes up over the next, call it 6 to 12 months. That's going to drive the short-term performance.
Thank you, Jamie. Second question is on the banks, and perhaps I could ask you to address this one, Bruce. There are essentially three questions here. Raising interest rates are good for the banks as they increase the spread on loans versus deposits, but now everyone is stating that banks will experience loan losses. If that's the case, is the first question, what will they have to increase? Will they have to increase their loan loss reserves? Second one is Bank of Nova Scotia has big exposure to South America. Will this result in higher reserves than other Canadian US banks? And the third is, which Canadian and US banks are you recommending?
Okay, it's a lot of stuff in there. So let's start off with the banks in general. The banks in general, yes, they benefit from higher interest rates, and they can make a bit of a spread on that. Offsetting that in the short term is the fears that as the economy is not as strong as it was, there could be loan losses. And so that's a bit of a negative. The other big negative, though, on earnings is capital market activity. The issuance of bonds and stocks, takeovers, et cetera, financings for these things are a big source of incremental earnings. When these companies are, when the economy is booming and that is doing well, it's 30 to 40% of earnings. And other years when we go through periods like we did in the first half of the year, that can drop pretty quickly down to, so it's a big mover. And that's the Morgan Stanley story. Morgan Stanley, as Mike mentioned, we've cut the weight substantially there because of that trend. And Morgan Stanley stock has fallen, from its peak, back late last year, early spring. As to, I just make a general comment, if you'd bought Canadian bank stocks back in 1975, when I entered this business, and just held them, you'd have outperformed the Toronto Stock Exchange very nicely. So the Canadian banking oligopoly is a very powerful source of long-term earnings growth, and that is why we do not hold many U.S. banks in our portfolio. The U.S. banking system is very different. And in my career, I think JP Morgan, Citibank have each been bankrupt twice and gone to zero. Number one, in the early 80s, we had something called the emerging market debt crisis, where countries like Argentina defaulted on massive amounts of money, and then of course we had the mortgage crisis in most recently in 2008, and Citibank, I think, got wiped out in 1990 by, I can't remember exactly what it was, but I think it was issues. So it's a much more volatile business, and therefore the stocks, you can make a lot more money in a U.S. bank in the short term. Both, I think right now investing in both sectors is probably okay. You probably have to wait though before, for the economy to stabilize before you get returns. I hope that, there was some questions on, right now the banks with most focus on the domestic economy are the ones doing the best. That's tends to be CIBC, National Bank, and Bank of Montreal And Royal Bank's always a mixture. It's never the best, never the worst, but does just fine over long term. Bank of Montreal's exposure to the U.S. They made an acquisition of a bank in Milwaukee, I think it was about 5 years ago, and they've got a very big exposure to the U.S. manufacturing business as a result of that. And so that is, as manufacturing turns, that's expected to do quite well. As to the South American issues in Scotiabank, is being punished because of the global downturn in things. The South American countries, Peru is one of their bigger economies, and Chile, which is a smaller component of Scotiabank, but they're still there. For example, are increasing taxes on the copper prices on copper mines, and that is slowing development of new copper mines, which slows Scotiabank's activity. It slows the economy in general, and so that is what Scotiabank's issue is. But Scotiabank has a nice fat dividend. You can buy it. It's got great Canadian assets that'll carry it in the short term, and when those countries turn, which they will, it'll go to the top of the bottom. So that's probably a year and a half, 2 years away at the earliest.
Terrific. Thank you, Bruce. If I could keep you for one moment longer here, could you please address the implications on the market of the inversion of the yield curve with the 5-year bond currently at 2.99% and the 10-year at 2.85%? That question just came in.
Sure. That is a traditional call for recession. As we had in our earlier in our presentation, we talked about, technically we had a recession in the first half of this year. And yes, actually the economists use shorter term money, which is still below the 10-year bond, but the 2-year bond is also above the 10-year. So we are not going to have a recession in the next year because the economy is going to open up. You cannot have a recession when anybody wants a job can go and get one, and when auto production is going to rise 40-50% along with a lot of other things, and the economy is reopening. Restaurants, for example, are still struggling for employees, and there has been layoffs in higher value-added businesses such as technology startups. For example, if you're working at a technology startup, there's a chance you're going to get laid off, and those will be higher income jobs. There is mild evidence. There's some mild evidence of wage inflation coming in, but it's not pervasive enough to say it's going to happen. And so we think wage inflation will be controlled, and therefore, a recession could come. A recession could come when the economy catches up to production levels, and then you get production fills the unmet demand for automobiles, etc. Housing is one that, as we talked about, there's massive unmet need, but it's just the price is high. So maybe, if we see that come down, that'll start up again. But the recession could occur sometime 12 to 18 months from now, when production actually catches up to demand. And my dad was a purchasing agent. When he couldn't get steel, he bought steel from everybody. And first guy to deliver it was fine. Second guy to deliver it was fine. They just build inventory, but they stopped buying steel. And that's what so we could have an inventory recession. It shouldn't be that deep because the entire business community is scared, focused on the potential of recession. But it still could happen just due to the facts of the inventory cycle. I don't think it'll be that punishing on the stock market at that time because it's well thought out at this stage.
Thanks, Bruce. This next one is from an individual that is retired and trying to preserve capital and generate some income. And the question is the oil and gas sector overvalued? Jamie, perhaps you could take this one.
Sure. I mean, I certainly hope it's not overvalued because we've been buying oil stocks in the last 6 months. But I mean, definitely we've seen prices that, the spot price on oil come down pretty significantly in the last 3 months. It was getting a little bit high. When you really start hearing people really complaining about gas prices, that's when demand is most likely starting to get affected. We've seen some additional supply, come in from, like I said, the U.S. Strategic Petroleum Reserve. It seems like Russian oil production is still finding buyers for temporarily. There's the Iranian production as well. It seems like it's coming back online. So there's been some shorter term headwinds to oil prices, but we're seeing natural gas prices, I think, hit like a new decade high today, both in Europe and in Canada. Oil prices were the spot prices today around $80, $85. It's still a very healthy level for especially the North American producers. Most of them have marginal cost probably around $55, $60. So anytime you're above that, they're making excess profits. And like we said, we think if the economy is gonna remain strong for the foreseeable future, some of these shorter term oil supply headwinds are gonna go away, and it will create a little bit tighter market. So we're probably it's probably getting to a good point now to start rebuying after that. We had that spike up in oil stocks and energy stocks in early June, and now's a good time to start dipping back in. As we said, we've been buying BEP. We got a Whitecap's another name that we like in Canada. They're doing a big acquisition of XTO Canada, which is going to give them a nice balance between natural gas and oil, and really extend their drilling inventory for 5-10 years. So those are two names that we look at. But yeah, I mean, they're producing lots of cash at these prices, and we think these prices are going to sustain for a few years.
Thank you very much, Jamie. And I have just, in interest of time here as well, I just have one more question for you. And I know this probably is going to sound like a layup, but it's not from me. It's from someone, one of our participants. Is now a good, I guess there's two questions here. One, do you think this is a dead cat bounce? And two, is now a good time to invest in the market? That would be the last two questions that I have from my end. Bruce, perhaps you could take that.
Yep, happy to take that. I mean, I have lived through many business cycles and some horrifying markets, and the downturn here was quite substantial, but yet the economics behind it were not as terrifying as a lot of the earlier ones. Interest rates were not at 22%. Gasoline prices weren't so high that people stopped driving, etc. Has happened in the mid 70s. So yeah, and yes, we believe the economy is on a recovery chain. It's going to, and we're going to be held back by Europe and China through their COVID policies. China's got a real estate crisis going on at the moment as well. But we believe profitability will hold in. We believe the valuations are good, and so yeah, we feel very comfortable investing. I feel very comfortable investing right now. In fact, I borrow money to invest right now.
Okay, that is the end. That's the end of our questions. So Bruce, if I'm sure you'd like to thank all of those on the line and perhaps do a little bit of a wrap up. So I'll pass back to you.
Sure. Thank you. So as we pointed out, our title is "We've Seen the Bottom. Is now the time to invest?" And we believe it's certainly the time to start investing. Maybe not all of it. There's markets are unpredictable. We believe though that the fundamentals will push it up over time from here. And we thank you all for attending our presentation. And if we can be of further assistance to any of us, please feel free to contact us. So thank you and have a good day.
Thanks, everyone.
Thank you.
All right.